Welcome back, Strongman Personal Finance. We got to cover the earnings of SoFi Technologies. But before we do that, you need to check out the pinned comment below and let me do your 2024 taxes because I am a CPA and I'm good at what I do and I want to make money. Anyway, let's go ahead and dive right into SoFi Technologies. So the stock is down 6.43%. Right after earnings, what could have happened? Here we have the Q3 2024 summary results. So first of all, we look at new members. Who's putting their money into SoFi now? I got to get in there so I can get that high interest rate, bro. So the member growth year over year is 35%. They're still posting pretty impressive member growth. Now, they're probably enticing people with high interest rates and other perks, and that could potentially hurt margins. But so far, it's been good for growth, okay? They've been definitely bringing more people in because once you get somebody into the system, then you start offering them other products like the garbage ETFs that they offer, and you could potentially make more money from the customers you have that are depositing with your bank. So membership growth, decelerating, but it's still pretty incredibly strong. I mean, it's a growing company, 35%. New products, bro. New products offered. So they've increased products given by 31%. So their membership grew by 35%, but products grew by 31%, okay? Still pretty impressive, but also decelerating as expected with the growing business. Galileo is only up 17%. It's basically, it looks like it's almost flatlining to be perfectly honest, but we'll see about that. But so far, Galileo accounts are up 17%. So pretty decent growth. Lending products. They grew lending products by 19% and financial services products by 33%. Now, one thing I'm happy about with SoFi is they're actually trying to diversify a little bit more away from their lending products because they're known for personal loans. I know I get their garbage in the freaking mail all the time. And personal loans are higher risk loans. They are higher risk than, say, a mortgage, okay, generally. I mean, ask that in 2008. But in general, a personal loan is, people take that for like debt consolidation, et cetera, or maybe they got to renovate something. But they're a lot more risky because they're not necessarily collateralized by anything. So if the payer defaults or if the borrower defaults, what's your recourse? Right? I don't know. I guess you just lose the money. The bank loses the money. Whereas if somebody doesn't pay their mortgage, the bank can take the house. So it's collateralized. Okay. However, personal loans have higher interest rates because they're more risky. So SoFi can use that. They can draw people in. They can send out an ungodly amount of mail. And they can potentially push people into personal loans, which is part of their business. But they're also growing financial services, okay? 33% year-over-year growth. Pretty good growth, okay? So I really can't hate on the growth. There's nothing to hate about the growth metrics. It's more about, the underlying risk associated with their personal loans, which so far hasn't done that bad. But if we ever hit dark times, this stock could collapse, okay? This stock would probably collapse a lot more than a company that offered conservative mortgage loans to rich people with high income and no debt, for example, okay? It's all about risk and reward. It's all about the economy, brah. Okay, so basically they're just showing the trend of how money gets into how people deposit their money and how they, entice people to use more of their products so they can make more money off of them. So, okay, financial services and tech platform revenue by Avenue. So we see that it's growing pretty significantly, okay? Financial services so far is their fastest growing business segment from what I can see. So they're bringing people in and they're making them do financial services. Okay, whatever they're freaking offering. Now, here's a big one right here. You want to really pay attention to this. The hugest risk to SoFi is their loans, their personal loans. This shows default rates as a percentage of the loans. So the gray line is loans that were originated in 2017, and what is that? Pink? Am I colorblind? The purple line is loans that were originated between Q4 2022 and Q4 2023. And they're basically saying that they're recording fewer credit losses on newer loans than they did previously. Wow. Okay, you have to look at that in context of other banks that offer similar types of loans. I mean, I don't know any other banks that mostly do personal loans. Maybe they're out there. But you can see for the 2017 loans, it had a roughly 7.85% default rate. Whereas the current loans, they're defaulting less, but that could change depending on economic circumstances. So that's the risk that you're taking with this company. And they're pretty heavily into loans, okay? So we know default rates are down compared to 2017, but you want to compare that to the overall market or an overall default rates and watch closely the default rates of personal loans. Okay, so revenue by revenue, adjusted net revenue. I would never trust that. That's up 30%. Adjusted EBITDA is up 27%. Okay, that's also a clown metric. Whenever you see adjusted, completely ignore it. It's garbage. Okay. All right, blah, 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 blah. Let's see. What's the guidance? We expect to deliver financial services net revenue growth of more than 80% versus 2023 levels. Okay, growing massively. Lending adjusted net revenue of at least 100% of 2023 levels. So they've basically, the revenue from lending is flatlined. That's what that means. Tech platform net revenue percentage growth of low to high teens versus 2023 levels. So basically all their growth is coming from financial services. They're still originating a decent amount of loans, but most of the actual revenue growth is coming from financial services. So that's what you have to pay attention to on top of the potential risk that comes with the personal loans. All right, we now expect to deliver between 2.54 to 2.5 billion in adjusted net revenue. Blah 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 blah. So I guess they're still posting, or they're projecting good revenue growth. I can't compare it on here because in stock analysis, because adjusted net revenue, it doesn't show up on here because it's a clown metric. But overall annual growth is going to be between 22 and 23%. So still pretty healthy growth. And they're projecting positive GAAP net income for the year. Okay, so we're profitable. Amazing. Let's look at the financial stuff. So this is kind of hard to read. But we could see membership growth, 34.7% for Q3 2024. Just trust me, I'm reading it. It's small as heck to see. Product growth is up 30%. Lending product growth is up 18%. So the lending products are growing, but their revenue is not. Interesting for lending products. Financial services revenue growth 32%. Products excluding digital assets up 36%. So, overall, pretty good growth. Let's see loan originations. So, for Q3 2024, they originated $943 million of student loans, almost $5 billion of personal loans. Wow. And home loans of $4 billion. So they're still going all in the freaking personal loans. Yeah, they're diversifying, but still pretty scary, especially if things go rotten in the economy. Okay. All right. So let's see. Net interest income is flat Q over Q. That's interesting. Let's see. Total non-interest income's up a little bit. Let's see. Contribution profit from lending. So their profit from lending is $226 million in this quarter. And in the prior year was 208. So they're still, I was looking at the wrong one. Sorry. Their profit for, this thing is freaking horrible. For Q3 2024, their contribution profit was $238 million versus $226 million in the same quarter of the prior year. Okay. Or $203 million in the same quarter of the prior year. So they're still growing profit from lending, but it's profitable now. I don't know. We'll see about the future. Tech platform profitability, $32 million in Q3 of 2023, $32 million in Q3 of 2024. So their contribution profit basically hasn't grown for their tech platform. For financial services, however, that's where all the profit growth is coming from. So they posted a $3 million contribution profit from financial services in Q3 of 2023, and they posted almost $100 million of profit in Q3 of 2024. So that's impressive growth right there. Okay, that's where a lot of the profit is coming from. Still, the largest profit came from lending, but financial services is massively catching up. It's pretty impressive growth from $2 million. Or $3 million to almost $100 million of contribution profit. That's pretty good, okay? So, let's see. Okay, but basically they're showing their margins from issuing debt, et cetera, et cetera. Fair value of loans. The current fair value of their personal loans is $17 billion. $17 billion. Student loans come at $7.8 billion. Home loans come at $81 million. So roughly, what percentage of their loans are personal loans? 68%. And then the prior year, their loans were, let's see, 20.99, 70%. So the fair value of the personal loans is still well over 65%, 68, 70% in the most recent quarter. So it's still a big personal loan company, but that's not where their profits are coming from. Okay, let's see. 90-day delinquency rates. This is also key to look at, okay? For Q3 of 2024, they have a 0.57% 90-day plus delinquency rate. That's a little bit higher from 2022, et cetera, but it's not like at critical levels. Student loans is 0.12%. That's almost zero. Let's look at their balance sheet, okay? As we can see, we know the personal loans are a huge part of their balance sheet. $17 billion versus $7.8 billion of student loans and $81 million of home loans. So they basically don't do any home loans, okay? They have $2.3 billion of cash, $614 million of restricted cash, and $1.5 billion of investment securities. And they have deposits of $24 billion, okay? So, I mean, what could bring down this would obviously be a bank run, but that's a risk that any freaking bank can happen, okay? But overall, they have positive equity because they haven't had to write down any personal loans yet, at least so far, or not a significant amount. So, overall, the only thing that I'm really impressed with is the contribution profit growth that's coming from their financial services. That's actually a good thing for SoFi. So contribution margin profits for financial services have grown. Tech, basically no growth. Loans, a little bit of growth. And that's SoFi for you. Let me know what you think in the comments. Hit like and subscribe. Check out the pinned comment if you want me to do your taxes. You probably should let me do that, especially if you have a business. If you want to talk to me one-on-one, if you want to buy my book, Stop Being a Broke Loser, or if you want a sponsored video. Have a wonderful night.